The most notorious financial scams explained. Bernie Madoff's Ponzi scheme. Bernie Madoff orchestrated the largest Ponzi scheme in history, convincing investors he was a financial wizard delivering steady, above-market returns. In reality, he used funds from new investors to pay returns to earlier ones, creating a facade of profitability. The collapse of his scheme wiped out $65 billion, affecting not only wealthy individuals but also charities and retirement funds that had trusted him with their investments. The fallout went beyond financial loss, significantly eroding trust in financial institutions and advisors, and highlighting the critical need for more stringent oversight and regulation in the financial industry. Enron Scandal. Enron's executives used sneaky off-the-books accounting tricks to hide billions in debt and inflate company profits. This massive deception made Enron look financially healthy and innovative, fooling investors, employees, and the public. With $63.4 billion in assets, Enron's collapse became the largest corporate bankruptcy in U.S. history until Worldcom's downfall the next year. This scandal wasn't just a bankruptcy, it was also the biggest audit failure ever. The fallout was enormous. Thousands lost their jobs, stock values plummeted, and billions vanished from pensions and stock prices. This disaster shook confidence in accounting practices, leading to new regulations like the Sarbanes-Oxley Act to boost corporate governance and transparency. Charles Ponzi's scheme. Charles Ponzi lured investors with an irresistible promise: hefty profits from the arbitrage of postal reply coupons, claiming a 50% profit within 45 days or 100% profit within 90 days. His real strategy? Using funds from new investors to pay off earlier ones, instead of generating legitimate earnings. This scheme led to massive financial losses, costing his investors $20 million and shattering public confidence in investment opportunities of the time. It also set a precedent for future scams, giving a name to the now infamous Ponzi scheme. This infamous debacle not only exposed the dangers of too-good-to-be-true investments, but also highlighted the need for stricter financial regulations and vigilance against fraud. The Worldcom Fraud. In 2002, Worldcom, once a telecom giant, was caught inflating assets by up to $11 billion through shady accounting tricks. They misclassified expenses to artificially boost capital assets. Worldcom's collapse was one of the largest bankruptcies ever, with an impact on thousands of employees and rocking the global telecom industry. This scandal triggered major reforms in corporate governance and accounting standards, including key parts of the Sarbanes-Oxley Act. Adding to the drama, CEO Bernard Ebbers was sentenced to 25 years in prison, showcasing the severe legal consequences of corporate fraud and adding a twist to the already massive scandal. The Fyre Festival Fraud. Marketed as a luxury music festival in the Bahamas in 2017, the Fyre Festival promised an elite experience with top music acts and high-end amenities. But instead of paradise, attendees found inadequate food, shelter, and security. The organizers lacked the infrastructure and funding they claimed. The festival's collapse led to a $100 million class action lawsuit for fraud, exposing the dark side of influencer marketing and the need for transparency in event management. The Fyre Festival fiasco became a viral sensation, sparking documentaries and media coverage that highlighted the power and pitfalls of social media influence. The Luckan Coffee Accounting Scandal. In 2020, Luckan Coffee, touted as China's answer to Starbucks, was caught fabricating over $300 million in sales. The company used a complex web of fake transactions with related parties to inflate its financial performance and mislead investors about its growth. The scandal caused Luckan Coffee's stock to plummet and led to its delisting from the Nasdaq, a major global electronic marketplace for buying and selling securities, known for listing many top technology companies. This debacle not only shattered investor confidence in Chinese companies, but also highlighted the urgent need for stricter audit processes and greater transparency for firms listed overseas. The fallout also sparked debates on regulatory oversight and the reliability of financial disclosures in the global market, emphasizing the importance of robust corporate governance. The Olympus accounting fraud. Uncovered in 2011, the Olympus scandal rocked the corporate world. This major Japanese electronics and optics company had been hiding losses of $1.7 billion for over 20 years. Executives used sneaky accounting tricks to mask these losses and inflate the company's net worth. The scandal caused significant financial and reputational damage for Olympus, leading to the arrests of top executives and substantial stock price declines. It also triggered global concerns about corporate governance practices in Japan. This debacle not only shook the business world, but also prompted calls for more rigorous oversight and transparency in Japanese corporations, highlighting the need for stricter regulatory measures to prevent similar frauds in the future. The Libor manipulation scandal. In 2012, a shocking scandal rocked the financial world. Several major banks were caught manipulating the London Interbank Offered Rate, aka Libor. This rate isn't just a number, it's the backbone of global finance, setting interest rates for everything from mortgages to student loans. So, what did these banks do? They falsely inflated or deflated their rates to boost trading profits and appear more creditworthy than they actually were. This deceitful practice affected millions of contracts around the world, shaking public trust in financial markets. The fallout was massive. Banks faced huge fines and legal consequences, and the scandal sparked a global outcry for more reliable financial benchmarks. This event underscored the critical need for transparency and integrity in the financial industry, showing just how high the stakes are when trust is broken. The Stanford Financial Group Ponzi scheme. In 2009, Alan Stanford was charged with orchestrating a massive Ponzi scheme through his Stanford Financial Group, claiming to offer secure investments with high returns. In reality, Stanford was using new investors' money to pay off existing ones, while funding his extravagant lifestyle and various side businesses. This colossal scam defrauded thousands of investors, resulting in about $7 billion in losses. It wiped out retirement accounts and shattered the financial security of many, significantly undermining confidence in investment firms. To add to the madness, Stanford's downfall was marked by a dramatic FBI raid on his headquarters, revealing the extent of his deceit and greed, and leaving a bitter impact on the financial industry. The Z-Best carpet cleaning company scam. In the 80s, Barry Minkow founded Z-Best Carpet Cleaning and Restoration Company that turned out to be a front for a massive Ponzi scheme with ties to the New York mob. Minkow lured investors with fabricated contracts, showcasing fake rapid growth and profitability. The scam unraveled, leading to a $100 million loss for investors when the company went bankrupt. Minkow's conviction exposed glaring weaknesses in regulatory and oversight mechanisms that failed to verify the company's operations. Minkow's charm and audacity in duping auditors and investors turned his story into a cautionary tale about the dangers of unchecked ambition and deceit in the business world. Wirecard Scandal. In 2020, the financial world was rocked by the Wirecard scandal, involving a German payment processing company that claimed to handle billions in transactions. Wirecard CEO Markus Braun and other executives were found to have inflated the company's balance sheet by 1.9 billion euros, money that simply did not exist. The fallout was catastrophic, with Wirecard's stock plummeting and the company declaring insolvency. This scandal caused massive financial losses for investors and exposed serious flaws in regulatory oversight. The scandal included the mysterious disappearance of COO Jan Marsalek and allegations of ties to organized crime, making it one of the most sensational financial collapses in recent history. Theos Fraud. Theranos, under the leadership of Elizabeth Holmes, claimed to have revolutionized blood testing technology. The company falsely claimed their device could run comprehensive tests with just a few drops of blood, attracting significant investment. The exposure of the fraud led to criminal charges against company leaders and severe financial losses for investors. It also highlighted the risks of speculative investing in unproven technology and the importance of scientific validation in healthcare investments. The Great Salad Oil Swindle. In the early 1960s, Anthony Tino DeAngelis orchestrated the Great Salad Oil Swindle by using tanks of salad oil as collateral for loans. He fooled inspectors by filling the tanks mostly with water and topping them with a thin layer of oil, vastly inflating his inventory's worth. This audacious fraud led to the collapse of his company, causing significant losses for creditors and investors and sending shockwaves through the commodities market. The scandal stands as a classic example of how commodity-based fraud can manipulate market prices and erode investor trust, highlighting the critical need for rigorous oversight and verification in financial transactions.